Are you tired of constantly falling into market traps, missing key reversals, and not knowing why smart money keeps winning? What if I told you there's a strategy that could turn those failed trades into winning opportunities? Today, I'm going to unveil the powerful secret behind the breaker block, one of the most underrated strategies used by professionals to maximize their profits. And here's the best part, it's simpler than you think. We'll dive into how to identify winning breaker blocks in the market, the psychology behind breaker blocks and why they form, order blocks versus breaker blocks, what you need to know, spotting liquidity sweeps before they happen, understanding market structure shifts like a pro, how to consistently find high-quality breaker block setups that lead to massive profits. If you're ready to finally stop guessing and start trading with confidence, then stay tuned. This is the game-changing strategy you've been waiting for. A breaker block is essentially a failed order block that is typically found after a liquidity sweep or a market structure shift. When the price fails to respect an order block that was expected to hold, that level turns into what we call a breaker block. But before we get too deep into breaker blocks, let's first take a step back and talk about order blocks. This will help set a foundation and make it easier to understand how and why breaker blocks form. Order blocks are critical zones in the market where large institutional traders, also known as smart money, place their buy or sell orders. These zones represent significant supply and demand levels that have already been rejected by the market, making them highly relevant for future price action. When the price returns to an order block, there's a strong chance that the market will react again, offering potential trading opportunities. However, not every supply or demand zone qualifies as an order block. Knowing how to distinguish valid order blocks from others is essential for improving your trading strategy. So what defines a valid order block? When institutional traders or large players enter the market with significant positions, they leave behind footprints in price movement. These areas are what we refer to as order blocks. But for an area to be classified as a valid order block, certain criteria need to be met, making it more reliable for future trades. Let's go over the key conditions that define a valid order block. Inefficiency. A valid order block often reflects an inefficient price move, where the market quickly moves in one direction, leaving behind a clear price imbalance. This usually happens because large institutional orders push the market sharply, creating gaps or unfilled areas in the price action. This imbalance signals that smart money is involved, and the market will likely return to that area to rebalance the price. The second key condition: liquidity collection. Order blocks are characterized by their ability to collect liquidity. This happens when the market manipulates price, triggering stop losses or pending orders placed by retail traders. Smart money often uses these liquidity grabs to fuel their positions before moving the price in the opposite direction. Break in market structure. Finally, the most crucial criterion for a valid order block is that it must cause a break in market structure. This is what distinguishes a regular supply or demand zone from a true order block. In a bullish market, when the price breaks above a significant previous high, the area where the price originated becomes an important demand zone, known as a bullish order block. Conversely, in a bearish market, when the price breaks below a key low, the area of supply that caused this breakdown becomes a bearish order block. So, now that you have a clearer understanding of what an order block is, and how to spot one on your chart, let's discuss what happens when things don't go as planned. No strategy is foolproof, and that includes smart money concepts. Sometimes you might find an order block, set up your limit entry at the zone, place your stop loss below it, and aim for the next level, only to watch the market break through the order block, hit your stop loss, and continue moving in the opposite direction. Why does this happen? There are a few possible reasons why the market might ignore an order block. A shift in market structure, the market being overbought or oversold, the release of major economic news or other fundamental factors. When an order block fails, it essentially means that the level didn't hold, and the market broke through it. But here's the important part. When an order block breaks, it often transforms into a breaker block. The market treats this breaker block as a new opportunity. So when the price revisits this zone, it gives you another chance to enter the market, this time in the opposite direction. Let's take a deeper look at the psychology behind breaker blocks and understand why they work so well. The psychology behind breaker blocks lies in trapping traders who entered at the original order block and exploiting their expectations. Imagine this. The market breaks a structure above the previous high, forming a valid order block. This offers traders an opportunity to go long, believing that the price will respect the demand zone. However, if the market shifts and breaks below the most recent low, the directional bias changes to bearish. The original demand level, the order block, becomes a supply level as the market breaks through the zone and turns it into a breaker block. Now, traders who went long at the original order block are trapped. These traders are waiting for the price to return to their break-even point so they can close